And across the borders, the central bank rate in Uganda has been raised to control the rising inflation. Policymakers have attributed the trend to supply and demand imbalances that were caused by the COVID-19 pandemic and escalated by the Russia-Ukraine conflict that started in February. Here are the details of the story and much more from across the continent.
Uganda's central bank has increased the central bank rate to 7.5% from 6.5% to control the rising inflation, as it is spreading broadly across the basket of consumer goods and services. The economy is projected to grow in a low range of 4.5 to 5%, as the latest consumer price data indicates a sharp rise in the price of essential commodities such as food, cooking oil, soap, fuel, and transportation. Economic experts worry that if prices continue to increase faster than real incomes, people will not be able to afford goods and services, and the result will be a slowdown in domestic economic growth. The government says that it will not reduce taxes or offer subsidies on essential commodities, as the country's economy will be hurt by doing so. Meanwhile, a corn flour processing plant project aided by the Chinese government was officially handed over to a Zambian government. The project will help the country's agricultural development and food self-sufficiency and benefit the Zambian people. The Chinese ambassador to Zambia said the completion and delivery of the project is another milestone in the friendship between China and Zambia. Over the years, the Chinese government has been committed to supporting Zambia's agricultural development and food security through various forms. Finally, fuel prices in Tanzania have dropped after a $43 million subsidy was activated by the government to manage the arising concern of a hike in fuel prices. This led to a price drop of $0.13 for petrol and $0.14 for diesel per litre. The government has set up a fuel prices stabilization fund and a national strategic petroleum reserve. It has also allowed the private sector to play a more active role in importing fuel into the country. However, taxes and levies paid to various government departments and agencies amount to about 40% of the fuel price consumers pay at fuel stations.